Crude oil prices have dropped more than 50% in recent months, leading some economists to predict a recession might be hitting Texas. So what does this drastic change in the energy sector mean for Texas's individual economies, in particular for the four big apart markets? Welcome to Apart Market Dynamics from MPF Research. I'm Jay Parsons. He's Greg Willett. And Greg, it's been interesting to see how various media outlets have been covering this just big drop-off in energy prices and the potential impact in Texas. And it's really a story that needs a lot more understanding than what tends to be given, because all across Texas, the individual markets tend to be very different. And the role the energy sector plays could vary from one market to the next. So we've decided to take a tour of Texas, looking at the four big Texas apart markets and the impact that the energy sector might be having on each of these places. And we're going to start off appropriately with Houston, which may be most vulnerable to this big change.
It is the vulnerable one, Jay. And we, on the Real Page Property Management Insider blog, a month or so ago, we actually did a pretty in-depth analysis of the role that energy plays in the Houston economy. But so for here, let me just recap a few thoughts from that one, some key points for you. First, about half of Houston's 3 million jobs are tied to energy. For every job specifically in that energy field, there are another 2 or 3 that are related in some peripheral fashion or that just depend on consumer dollars spent by those holding energy sector positions. So the shift in energy's momentum actually is a really big deal for Houston. Another point on the local economy, we'll be scaling back from economic expansion that has been stunningly strong recently. Growth in 2014 totaled 125,000 jobs. That was up about 25% from the already robust figures seen in 2012 and 2013. And then a final point here, expected growth in 2015 is about half of 2014's total. Thus, look for Houston to gain about 60,000 jobs during the coming year. That's still a pretty big number. And in fact, the corresponding economic growth rate is roughly 2%. So about in line with, to maybe just a little bit below what we're expecting for the nation as a whole. And that forecast assumes that we're going to have oil prices that rebound a little bit from where they are now, and by the end of 2015 reach somewhere in the range of $60 to $80 a barrel.
So the forecast is that Houston's economy is slowing from a currently very strong position, and the same could be said of the apart market. In terms of occupancy rates, year-end 2014 came in at 93.8%, 150 basis points above the norm that was posted during the past couple of decades. And while occupancy in Q4 did drop meaningfully over Q3's 13-year high, most of that shift appears to just be normal seasonality. And on the pricing front, effective rents for new leases in Houston climbed 5.2% in 2014. That's among the strongest year-over-year performances ever seen for the metro. Growth was especially robust in Class B communities, 6.9% growth there. And we also had some good price growth in each other end of the product spectrum, just under 4% year-over-year growth in Class A as well as in Class C properties.
Jay, as you think about what's going to happen in Houston's market, certainly the employment growth outlook is a little bit more challenging now. And another factor that is challenging in Houston is how much construction is going on. And you do have developers building at that pace that they're expecting the really strong growth numbers to continue. Currently under construction in this metro, we have 33,586 units underway. That's the most anywhere across the country. Of the deliveries that are scheduled to finish in 2015, that's 23,420 units. So 2015's new supply number should roughly double the number of units we added in 2014. The really competitive environment is going to be in the urban core. At the top end, when you look at how much construction is going on, about 39% of Houston's 2015 deliveries are going to come online in what are really the most expensive submarkets in the urban core. And then another 10% of the product on the way is on fairly expensive product, a little bit more than the metro average for new supply. So again, competitive at the top end of the market.
So combining those supply and demand outlook, we get occupancy going down about 90 basis points in 2015. We also think rent growth will cool down to about 2.9% over the next year, and that would bring overall revenue change right around the 2% mark. And that performance is certainly below, well below what we've seen in recent years. But bear in mind, it's still growth. It's not going negative. We still expect to see some growth. Just maintaining some positive results considering this environment and what's going on in the energy sector is impressive considering what's going on in the economy. And it's definitely a drastically different outlook from what was the case in the 1980s, the last time we really saw a crash in the energy, well, a true crash in the energy sector. And certainly we don't see that scenario playing out again.
And Jay, I'm old enough to have started my career back in the mid-1980s, and I will have to say that today's environment really doesn't so far feel anything like that. But I will point out there is some downside risk to this forecast that we're presenting here, and certainly there is no guarantee that oil prices will end up at $60 to $80 a barrel roughly a year from now. That's the number that makes sense when you look at what's happening with the supply and demand numbers in the oil sector, but geopolitics could be involved, and that's really a tough variable to model. So we will see what happens.
Yes, we will. And that's going to wrap us up for our Houston outlook. But join us next time to talk about Dallas-Fort Worth and potential impact there. And that'll be followed up by videos on Austin and San Antonio. But until next time, for Greg Willett, I'm Jay Parsons. Thank you for watching Apart Market Dynamics from MPF Research.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.